Welcome to the HCI family of podcasts. We're your source for personal, professional, and organizational growth and development. We share our own original research, explore industry trends, and interview executives and thought leaders from across the globe. Join us for practitioner-oriented content around all things leadership, HR, talent management, organizational development, and change management. Maximize your personal and organizational potential with the HCI family of podcasts. Welcome to the podcast. In this podcast episode, I talk with Mark Willis about how to think differently about your money, the economy, and the future. Mark Willis, welcome to the conversation today.
Thank you. Thank you so much. Appreciate it.
It is a pleasure to be with you. You're joining us from the Chicago area. I'm south of Salt Lake City in Utah. And today we're going to be talking about how to think differently about your money, the economy, and the future. And I have a wonderful guest today joining me. Mark Willis is a certified financial planner, a 3-time #1 best-selling author, the owner of Lake Growth Financial Services, a financial services firm in Chicago, and co-host of the Not Your Average Financial podcast. Over the years, he has helped hundreds of his clients take back control of their financial future and build their businesses with proven tax-efficient financial solutions unknown to most financial gurus. He has become known as Not Your Average Financial Planner. I love that. I love your background. Anything, Mark, you would like to highlight by way of your background, personal context before we dive on to this conversation?
Yeah, no one's saying I got a silver spoon in my hand when I was growing up. I certainly entered into my adult life with 6 figures of student loan debt and no plan to pay it off. Since then, we've been able to wipe clean the debt and not just pay it off the old-fashioned way, but actually helped it become the catalyst for our future wealth accumulation and become better than debt-free. And I've had the great privilege now as a certified financial planner of working with clients all over the country. A lot of them are, business owners, real estate investors, people who are looking for more control and certainty in their overall portfolio and don't want to just leave it to some investment guru. So that's become, I guess, my calling card is helping clients who already want some more certainty and control and access to their money, find particular strategies that help them do just that.
Yeah, certainty and control seems like a bit of an oxymoron in the current climate that we're in. But there are strategies you can use to kind of even out like the ups and downs, right? And to have a little bit more of a semblance of preparation for an uncertain future. And, most listeners to this podcast, they're focusing in on the organizational issues that they're facing. But we have lots of solopreneurs, entrepreneurs that tune in who are, dealing with these types of issues on a regular basis. And I suspect even those who are in C-suite or middle management roles within large firms, are still grappling with financial issues within their organizations and trying to grapple with and understand the nature of the economy today and how that contributes or detracts from the work we're trying to do and what we're trying to accomplish. So I think this will just be a fun conversation today as we unpack, some of the strategies and some of the ways we can shift our mindset to help us navigate uncertain times. I think back to the start of the pandemic, and I mean, even predating that, you can go back to 2008 during the financial crisis. There's always these cyclical ups and downs in the economy, but then there are also these catalyst events that also cause challenge. I was actually, I reflect on this from time to time. I was actually at a conference with my wife in Vegas during those days in 2008 when the banks started to fail and like day after day of like massive declines in the stock market. And I just remember looking at it, watching the news at night and just thinking, oh my gosh, what is going on? It's got to rebound tomorrow. And it just didn't. It just kept on diving and diving and diving and banks closing. And I'm like, oh my goodness. Now, that was a once in a generation, hopefully once in a century kind of an event. But then you have COVID, and you have the uncertainty in the market around that time period. And the reality is there will be other disruptions, whether it's a pandemic or a financial, a housing crash or whatever. Like there's going to be various catalysts that will move us into periods of uncertainty. So let's start there. And what does that mean for how we approach, the finances, whether it's personal finances or finances within our business?
I think it's great that you've mentioned kind of some background there. And you're right to say that it's probably not done. Is there a bell that's rung whenever the market is done with being volatile? No, it's never done. It's like a roller coaster that just keeps going and going and going. And it's thrilling in your early years, and it becomes, nauseating in your retirement years. The biggest problem is not when you go up the mountain, it's when you come back down. I'll tell you a quick story. I was doing some dirt bike riding, mountain biking with my buddy on some nearby mountains, and not in Illinois. There are no mountains in Illinois. So we had taken this trip out to Wyoming. We were doing this downhill mountain biking. And anyway, going up the ski lift was this peaceful, serene experience. Quiet, you could hear birds chirping, you're watching people riding their bikes below you. It's a lot of fun, it's relaxing. And then you get off the ski lift, and now you're riding that bike, hitting the dirt, hitting the rocks, hitting the roots. I end up flipping over my handlebars and break my wrist and go to the ER. Oh. None of that should be surprising to you, because I'm such a bad downhill mountain biker, and I was trying to keep up with my buddy. But it's a reminder, it's an analogy of how the financial life of most of us really work. While we're working our day jobs, our 401ks, our IRAs are just bouncing around in the markets, but we can't feel it because we're cushioned by our paychecks. Then we retire, and now we're off the ski lift, and we're going back down Mount Retirement, spending that money as we can. And when the market crashes and we are also going to spend that money for groceries and grandkids, that 401k assumes a double pain. The market's vaporizing our wealth, and we're also removing money at the same time. One of the strategies, and this has been recently touted by the investment group Ernst & Young, they actually brought that if you replace the bonds in your portfolio, which have been pummeled the last 24 months, if you replace the bonds in your portfolio with cash value life insurance, as an example, you can increase your yield, you can increase the income that you can take off your retirement, you can decrease the volatility, decrease the standard deviation, and increase the likelihood of a successful retirement. That's just replacing bonds with cash value life insurance. Now, most people kind of scratch their head at that, and they're like, what do you mean life insurance? How can life insurance be incorporated into my retirement? Don't you have to die to win with life insurance? And this was one of the shocks of my young adult life, is that no, there is this other kind, besides term insurance, there's this other kind of life insurance that has cash value associated with it. And if it's developed properly, it can provide some liquidity, security, even guarantees. The cash value itself grows guaranteed, so it's totally off of the market roller coaster. I like to say that you don't want to have all your eggs in one basket, but you also don't want it in 12 baskets on the same truck. Most people have their eggs in 12 baskets, 12 different mutual funds, whatever, but it's all riding on the same truck. And if that truck goes off a cliff, well, then what good were those 12 baskets? Let's put some money in non-correlated assets, another truck. One of those might be whole life insurance. Maybe there's other, forms of, annuity contracts or real estate or some other things as well, that gets that money not just diversified in the markets, but really, truly categorically diversified, so that you can even protect yourself against an all market downturn like we saw in 2008.
We were in that situation. It was probably 15 years ago or so. Actually, I know exactly when it was. It was right during the 2008 financial crash. That's when we started exploring whole life and the cash value life insurance. And we've had that ever since. And again, that wouldn't be my sole approach to preparing for retirement, but it's been a nice, complementary part of our plan and our package moving forward. And the whole point was exactly what you just said, to remove some of the volatility in what the markets were doing, so that we had some sense of stability amidst the chaos. And I know what that mix will look like is going to be different for everyone depending on what your goals are, and et cetera. But yeah, I just wanted to reinforce that as a potential option for people. And I like your analogy of not putting everything in different baskets on the same truck, because when the markets are hurting, it doesn't really matter. You can be diversified across a bunch of stocks, across a bunch of different mutual funds or whatever, and it's still going to be hurting. And so finding ways to diversify beyond that it can be very helpful, not just personally. So I just gave the example of my family and our own personal long-term investments, but within business as well. And as you're thinking about cash flow issues within your business, let's again suggest or say that we're talking right now about solopreneurs or entrepreneurs. You have to think through a lot of the same things in terms of your cash flow, in terms of the resources you have, the investments that you have, and what that means ongoing. And just like an individual can take a big hit in an economic downturn, certainly companies and small businesses do as well.
That's exactly right. And again, not to beat that drum, but let's think about what is it that causes a business to suffer or even go bankrupt. It's typically liquidity, and it's typically bank financing, because no one is able to make those bank payments when the markets are crashing and when customers stop returning your calls. And it's very scary time for a lot of entrepreneurs. And I don't know what the market's doing when you're listening to this podcast or watching this podcast. I can tell you that the uncertainty that you feel as you're listening to this is the uncertainty that's been felt by entrepreneurs and business owners since day one, since time immemorial. So liquidity is key. I don't think we put too high a price or a value. We need to put a higher value on liquidity. It has its own, you might say, rate of return. Liquidity has its own value or its own rate of return. It might be only earning a few percentage points wherever it's sitting, but if you have liquid piles of money from which to survive if it's a downturn, or even take advantage of opportunities. I use my cash value life insurance policy, whole life insurance, to invest in real estate. I use it to invest in my business. Having that liquid pool of money is, it's a counterweight to your risk assets. If you've got big pile of liquid money over here on this side of your barbell, then you can lift the other side of your barbell, which might be, your business investments or your speculatives or things that really are, further out on the risk spectrum. And it gives you that assurance that, hey, you've got that liquid money. You can take that risk. You can leave your day job. You can help send your kid to college, whatever that liquidity need might be.
Yeah. Very well said. Well, Mark, I note the time. I'm going to have to let you go here in a few minutes, but why don't we start to wrap things up? And if you can give a few suggestions, perhaps, 1, 2, even 3 things that anyone listening should be thinking about as they're moving forward amidst an uncertain economy and the shifting nature of the workplace.
Wow. Yeah. There's a lot that we cannot control. And a lot of people have noted that it sort of feels like you're just a tennis ball floating down the gutter of life. I don't like that feeling, and I don't want that for my clients. So find out what you want your money doing for you. That would be my first thing. And that might just be my first bit of homework, you might say. That might just be grab a legal pad or an app on your phone and just start writing out specifically verbs or adjectives, not nouns. I don't care if it's a CD or a savings account or a 401k or a hedge fund. Focus less on the nouns, more on the verbs and the adjectives. I want it. Let's just make a list to get you started here. I want my money to grow predictably. I want it to have low fees so that no one else is getting wealthy off my back. I want it to be tax-free when I access the money. I want it to be a source of collateral if I need to get a bank loan or another type of loan. I want it to be private so that it's not getting, brought up in in some sort of lawsuit or bankruptcy court, God forbid, or anything like that. I want it private and off the court's records, you might say. So that's just a short list. I mean, you and I could have another call talking about just that list, but that'd be our first bit of homework, you might say. Second is figure out what you're saving, because your savings rate is more important than your rate of return. So let's say you and I are both, let's just say we're both making 100 grand a year. And let's say that I can only save 3% of my money, but I'm doing 100% rate of return on some crazy crypto stock. So that means I'm putting away 3,000 plus doubling to 6 grand. Okay. You're still making 100 grand a year, but you can save 10% of your money, but you just put it in a tin can in the backyard, earning 0%, right? But because of your savings rate, you saved 10 grand. I could only scratch together 6 grand with crazy amounts of risk. So it's all about the savings rate. And that's one thing you can control is in essence, you can increase your savings rate. Now, try doing that 1% at a time. 1% per quarter is a great, maybe a doable strategy. Increase that savings rate by 1% per quarter. I see our time, so I'll keep it to 2 takeaways. Maybe the last quick takeaway, shameful self-promotion. Check out our podcast if you'd like to learn more about some of these strategies. You can find us wherever you're listening to this podcast at notyouraverageFinancialPodcast.com.
Wonderful. Yeah. And Mark, we've only scratched the surface here. There's so much more depth we could go into on this, but thankfully you have a podcast where you go into these topics in great depth. So I would definitely encourage the audience to reach out, get connected, find out more about what Mark and his team can do for you. Check out that podcast. And thank you for the conversation today. I hope everyone will think carefully about their investment strategies, both for their individual, their home, and family life, but also in the workplace and in the organizations you lead and support. These are very important things to think about. Not always the funnest thing to think about, but vital. So thank you, Mark. And I hope everyone will be able to stay healthy and safe, that you can find meaning and purpose at work each and every day. And I hope you all have a great week. Thanks for joining us for this episode of the podcast. We hope you stay healthy and safe, and please join us again soon.